This is Doug McIntyre. I'm the editor-in-chief at 24/7 Wall Street, and I'm here with Lee Jackson, who's our senior editor for markets and corporate covering and stock and anything you can think of that has to do with finance. How are you, Lee?
I'm good, thanks. How about yourself?
Good. So for the first time in a very long time, I can go into a bank and I can say, here's some money. I want 5% on it. And they can say to me, you're all set. Just, hand me the money and you're in. Uh, there was probably a decade where, you could get less than 2%, which meant
Easy.
putting it, maybe one, putting money in the bank in that way was almost certainly going to, underperform. Now that this has happened, how does it change the investing landscape that you can get that kind of a yield with no risk?
I think it's huge. And as I mentioned at one point today, earlier when we were talking, I read an article about how Warren Buffett sold 10 million shares of Apple. Now, granted, he still has 905 million, but the author's point is that with diminishing growth potential, the years of 20 and 30% growth for Apple are over, is the case he makes. And that Buffett would much rather put, that money into a 1-year CD, which is trading 1-year CD or 1-year T-bill, which is trading right under 5% now.
Yeah. The stock market is, I'm going to say, overvalued, and some people would say it's overvalued by an awful lot. Is 5% paper a good way to basically create for yourself a safety net if you're heavy in the market right now?
Oh, absolutely. And again, the huge raising hike period of the last 2 years, that has moved rates up fast because there was, I think, 275 basis point increases. Yep. So we went, like you said, literally from zero to the current Fed funds is 5.25, 5.5 in less than 2 years. And that was incredibly fast. And I think a lot of money managers would say, and especially the high net worth clients say, with the stock market as pricey and overbought as it is, wouldn't you like to taper some of that with 5% treasury yields?
Yeah. Let's think about this in terms of age tranches. You've got somebody, say one of my kids is, late 20s. Then you've got somebody, you sort of step it up in decades.
Right.
I would say to a 25, 30-year-old kid, you don't need any 5% paper, Go buy yourself some Facebook and, Snap and, Microsoft stocks that could go up literally 50% in a period of 2 years, but they could also drop 50%. And both of those things have happened in the last 5 or 10 years. Literally all the stocks we've mentioned, there's a portion of those that have dropped, like Meta, 50%. And over the period of a couple of years, they've gone up 60, 70, 80%.
Right.
So I don't think those people need to be in 5% paper. But what happens as you get older?
Well, I think even into your mid 30s, you're just starting to hit your peak earnings. You can continue to flood your company plan 401k. And even if you just index it or you 60-40 it, with 60% in, say, an S&P 500 fund and 40% in bonds, you can still take that risk. But the higher you go up the age spectrum, the more that 5% guaranteed money sure does look good.
When you think about this for a second, we may not see this again for a while. Is that fair to say? I mean, this isn't going to go to 8.
I don't think it does. We're probably tapped out, although we're saying that as immediately we saw a bounce back in the consumer and producer price index for January, which nobody saw coming, and which totally put the kibosh on any sort of interest rate decrease in March. And again, what would be when they do start to lower rates again, which of course they will, but they certainly don't do it anytime before the summer, and maybe not until the fall after what we've seen. But when they do start to lower them, or we hit some sort of 2000 or 2008 market crash, then they'll be ratcheted back down fast. And that's why paper like 5, 7, and 10 year, the 10 years at a 435, I think today. I mean, that's pretty good guaranteed money 10 years into the future.
Yeah, it is. Some people are going to compare this to yield. They're going to say, well, I'm going to get some Verizon. The yield is about the same. Why pick government paper instead of Verizon, or the other way around?
Again, just like you highlighted before, that's really almost an age and risk assessment question. Because if you're younger and you want to have total return and passive income, and remember, total return, Doug, is the increase in a stock's price plus any dividends paid to you,
Right.
whether you reinvest them or take the cash. So it's kind of age dependent there as well. But the older you get up that ladder, that guaranteed money, because, hey, big companies go out of business. Or in the case of somebody like Walgreens, where they had to just absolutely slash their dividend. It's still about 4%, but that's down from like 9%.
Right.
When that happens, you usually get a slash in the stock price as well.
Tell me if you think this is a potential dynamic. Stock market starts to fall relatively fast. People rush to 5% paper, and the attractiveness of 5% paper then starts to suck even more money out of the stock market, because people see that yield, that return you're talking about, it's going over on its belly, and suddenly they're looking across the way and saying, oh my God, that's 5% paper. Is that what happens?
Well, like you said, this is the first time since probably 2001, 2, 3, since you could get and again, back then, a 5 and 6% CD was 5-year piece of paper. And again, remember, for CDs, there's often a pretty stringent penalty if you come out prior to the maturity date. But now, I think that you're exactly right. The market's horribly overbought. The parabolic move higher from the October timeframe of last year, when Powell said, "Okay, no more rate cuts," I think it makes a lot of sense, and I think money across all age ranges that are coming out of portfolios, from people say 35 and up, I bet they don't have any problem taking 5% paper at this juncture.
I want to move to something that's a little bit more theoretical, but in this day and age, it's realistic to think about this. Is the federal government going to have to pay a higher interest rate? Let's sort of push the Fed off to the side a little bit as we become more and more and more indebted. I mean, at this point, it is, for our country, the debt levels are almost crazy.
They're insane. And what that has done is that some of the big foreign and international buyers, number one, the Chinese, they've stopped buying our debt. So is the Treasury going to be forced to pay 6%, 7%, or more? In other words, to get those foreign buyers back in? That's a very, very salient point and very possible.
Well, I think for people who don't always understand sort of the macro view of this, and it's not necessarily a reason for you to invest in government paper or not, I would think that we're very close to the point at which the interest paid on the government debt is going to be roughly what the entire cost of the American military is for a year, the entire defense budget, and interest payments for the United States, our debt, are going to be equivalent to each other very soon. And that's really a warning to people about the American debt. And I suppose in a perverse way, you could say, well, I'm going to take advantage of that. I'm going to get to the point where to get, the Chinese or somebody else back into this paper, they're going to have to go to 6%. And I'm going to let the government's misfortune work to my benefit.
Sadly, that may be the case. And I don't really see how we can ever repay, short of some incredible energy windfall or commodity windfall or something. I don't see how we can ever repay $34 trillion in debt. I just don't see it.
No. But for people who are our viewers and listeners, it is worth thinking about the fact that if you're interested in government paper or you're in it at 5%, the Fed does not necessarily have to raise rates more for the interest rate on the government paper to go up, because there's a simple supply and demand component to this.
The market can raise those rates.
Right. It's not, people say, oh, well, rates are because of the Federal Reserve. And the answer to that is no.
No.
Rates on government paper are based on supply and demand. The Federal Reserve may give people a point to look at in terms of whether that's rising or falling. But, as you look into the future, if you're thinking about buying government paper, you do want to take into account the fact that interest rates on government paper may go up, and they may not have anything to do with what the Fed does next.
Well, I think and that's exactly true. I mean, granted, the Fed funds is a benchmark for the bond market, but yeah, bonds came out at par, and if they trade higher, the yield goes down. If they trade lower, the yield goes up. And that's how they can, and that's obvious that the inverse thing is hard to explain to some, but that could definitely happen, and they could reprice the market anytime they feel that they want to. I guess the biggest issue going forward with the bond market, and what if, and this is something that may keep Jay Powell awake at nights, what if the inflation comes back? What if oil prices go to $100 because there's a big Middle East explosion in the war? Well, what if any number of scenarios drives inflation higher again and they start raising rates again?
Yeah. Well, a couple takeaways for us. The first one is, look, you can get 5% by walking into a bank and saying, I want to buy that government paper,
or calling your broker, or doing it yourself,
right? Or doing it yourself. You want to think about this in sort of the context of how old you are to some extent, how many years you think you're going to
absolutely
when is your peak earning power, things like that. Another thing you want to do is you want to say, do I think the market is overpriced? If I think the market is wildly overpriced, even if I'm in sort of the years when buying into the stock market is safer for my long-term investment horizon, you still want to look at whether or not the market is overvalued, even if you're 32, because if the market collapses, it doesn't help your cause as you move towards 72. So watch very carefully what you think the value of the market is, and look across the street, and that 5% over there waiting for you.
Well, and importantly, don't listen to the financial media, which I guess we're technically
don't listen to us, right?
But the financial media, I worked on Wall Street for 20 years. The financial media is never negative, never. And today, for instance, as we're discussing today, and this may air later, the whole market scenario is based upon NVIDIA's earnings. That can't be the total culmination for the market is what NVIDIA does with AI chips.
No. And then I guess the last thing I would ask people to remember is the Fed is not the sole determinant of what happens to that government paper you can buy. Now, the Fed may have to raise rates. As Lee said, there are things that people hope don't happen, like a war in the Middle East and oil going up. But you don't want to bet completely against the idea that rates are going to go down soon, because there are sets of circumstances where that won't happen. But keep in mind that in addition to all of those factors, the government is borrowing money now at a record level. And at some point, the chickens are going to come home to roost, and it's going to get so high that the government is going to have to pay more money to get that money in than what they're paying today. There's a good chance that you could see 6% on government paper if, like the Chinese huge buyers, if they just went into the market and say, we're not buying any more U.S. sovereign paper for 10 years, you watch how much more the government's got to pay to get money in to fund all of our federal operations and everything else the federal government does. So,
well, absolutely.
So,
well, and I guess one point that we should kind of keep here at the end is that what happens if our debt continues to escalate from the $34 trillion level up to, say, $40 trillion? Well, you can bet Moody's and all the other rating services will cut our debt again. And that in itself could push rates higher, because instead of a AAA or AA or even a single A piece of paper, if you start cutting sovereign debt ratings, that in itself could move rates higher.
Yeah, we don't want to look like Bolivia, but
or Argentina before they elected somebody else.
But you're right. You could get a cut. And a lot of people say, oh, it's doesn't matter. It's just Moody's. But you watch what happened if the three major services all make a cut and, have an outlook that's negative. You're going to start to see more pressure than the government would like to see on its borrowing capacity.
Oh, absolutely. And plus, that China is doing everything within their power to make their currency the world's, benchmark currency instead of the dollar. And if our debt continues to escalate, that could be another casualty.
Yeah, which would break something that's gone on for many, many decades. But in this day and age, it could happen.
Yep.
So, Lee Jackson, thank you. Talking about 5% paper today. We'll be back. And one of the things we may talk about next time is what happened with NVIDIA's earnings and then what happened to the stock.
We will see that after the close today.
Take it easy. Good to talk to you.
Thanks, Doug. Good to see you.